Hi guys, welcome back to my channel. Kelvin here. Many of us have a job, hopefully, and after all of your hard work, your boss will pay you money. You'll be like, yes, I'm a rich boy now. Then one day, the IRS comes along, sees your money and be like, oh, you have a lot of money, oh. It would be a shame if we take some of it. Then every year, you are forced to give, happily give 2 to 22% worth of taxes. So in this video, we will change all of that. I will tell you the 7 ways you can evade taxes. Legally, of course, on Cayman Island. Potentially saving you thousands of dollars in taxes. But before we start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel a lot. In return, I will show you a cute monkey who doesn't have to pay taxes. Probably. Alright, let's not waste any time and let's start right now. So, just in case you do not know, there are different tax rates depending on how much you earn. But I won't go into this, otherwise this video will be as dry as Asahi. Instead of calculating yourself manually, IRS has an Excel sheet for you to calculate how much tax you have to pay them. How nice of them! Let's say you earn 50k, then you will pay $1,250 in tax. And depending on what you do here, you can reduce your taxes. So let's go to all the ways that you can reduce your taxes. First, CPF cash top-ups. So this is super easy to do. All you need is top up cash into your CPF special account. You top up $1, you will save $1 on taxes. You top up $10, you will save $10 on taxes. Then you'll be like, wow, so good ah. Then I top up everything no? Hold up, don't do that because only up to 7k is not taxed. Any more than that, they will still tax you. Take note that this only works if your CPF SA has lesser money than the full retirement sum, currently at 186k. Also, you can do this CPF cash top-up trick for your loved ones, like your parents, parents-in-law, grandparents, grandparents-in-law, spouse, siblings. Then you might ask, what about my great-great-grandparents or my KTV girlfriend? Oh, they are not in this list, so cannot. For spouse and siblings, they must earn lesser than 4k per year to qualify. So obviously, the easiest method is still your parents and your grandparents. Same thing, 7k limit and account must be lesser than the full retirement sum. By the way, starting 2021 till 2025, there's a CPF matched retirement savings scheme. If you top up your parents' CPF, CPF will match dollar for dollar. You top up $1, they also top up $1, up to $600 per year. Got terms and conditions here, which you can see here for yourself. Now, of course, there are pros and cons to this method. Pros: if you top up to your CPF SA, you'll pay lesser tax and your money will earn 4 to 5% interest in the account. Cons is a one-way thing. You top up to your account, it will sit in there collecting interest and dust. After you retire, your money be like,
I've waited years.
How many years? 23 years, 4 months, 8 days.
So only do this if you have no better use for your money, yeah? If you need a tutorial on how to top up, Dollars and Cents has a step-by-step guide for you, which I will link down below. Second, CPF medisave top up. This is exactly the same as the previous point, but it's for topping up your own medisave. I'll quickly go through it because it's super simple. If every year you contributed more than the mandatory contribution, or $37k, $740, then you won't qualify. If your CPF has more than the basic healthcare sum, or 63k now, you also won't qualify. Okay, yeah. Next, topping up your SRS account. Just in case you're blur and you don't know what is SRS, it's short for Supplementary Retirement Scheme, which is a scheme to help Singaporeans prepare for retirement. Like deja vu ah? Just now you say the same thing for CPF top-up. Yup, the same but different. So here are the differences. First, for CPF, money go in, cannot come out until you become old. For SRS, money go in, can come out anytime, but there will be a 5% penalty. Second, for CPF, money go in, you earn 4 to 5% interest. For SRS, money go in, you earn a godlike amount of 0.05% interest. Then you'll be like, wow, like not very good leh. Okay, that's because SRS serves a different purpose from CPF. CPF main purpose is to lock up your money for old age, while earning a steady PP 4 to 5% interest. SRS, on the other hand, encourages you to put your money aside and invest the money. These are the stuff where you can invest your SRS money. Stocks, ETFs, bonds which are listed on the Singapore Stock Exchange, Singapore Savings Bond, Unit Trust, and so on. Then, after you reach 62 years old, you can finally withdraw from SRS and only 50% of the amount will be taxed. Again, there are pros and cons to this method. Pros: by topping up to SRS and only withdrawing at 62 years old, only 50% of the amount will be taxed. Second, let's say you are already investing in stocks or ETFs listed on the Singapore Stock Exchange. You can use your SRS to invest instead and at the same time save on taxes. But there are several cons to this. First, obviously, you can only withdraw the money after 62 years old. You could withdraw early, but there will be a 5% penalty. Second, if you are new to investing, there's a chance that you will lose your SRS money instead. So it's better to top up your CPF SA first, wait till you are better in investing, then only consider topping up your SRS to invest. Third, there have been talks about raising income tax in the future. So even if you save money now, there's a chance that next time when you withdraw, you will pay a higher tax. If you want to find out more about SRS, I've already made a video in the past. Check it out here if you want. By the way, right now, Endowus has the SRS promotion. If you invest $1,000 or more, you'll get a $20 SS fee credit. But wait, that's not all. The more SRS money you invest, the more SRS cash rewards you will receive, up to $80. And that's on top of the $20 SS free credit. So if you are interested, you can sign up using my link down below, yeah? Next, making donations. So you are kind-hearted and you like to donate your money to other people. To reward your generosity, IRAS will be giving you 250% tax deduction for your donation. Yay! This program will be available till 2023. There's no limit to how much you can donate. You can be like the Nigerian prince who wants to donate $1 million to me. Can, no problem. But not all the donations qualify. Let's say you donate $1,000 to the little girl who gives out Salvation Army stickers. That doesn't qualify. Or you donate to Kip Oji-san who's playing guitar by the roadside. That doesn't qualify too. Some of the ones that qualify are Children's Cancer Foundation, Club Rainbow, HCA Hospice, Singapore Cancer Society. If you want to see whether the organization is approved, you can go to charities.gov.sg, then search for it. For example, National Kidney Foundation is approved. By the way, it's not only cash donations. There's other kinds of donations which also qualify, like you can donate stock that are listed on the Singapore Stock Exchange, donate artifacts to museums, like maybe your uncle is an antique collector and he got something interesting, like the gauntlet. Then you can call the museum and see if they want it or not. Donate art to the National Heritage Board. There's even land and building donations, just in case, you're some rich Saudi prince and wants to donate some building. Take note that the tax deduction is only applied in the following year. Let's say you donate in 2021. Then the tax deduction will only be applied for 2022. Also, you don't have to go and declare. The organization will tell IRAS for you. So what are the pros and cons? Pros, you save on taxes, but more importantly, you gain karma points. That's a good thing. As for cons, I don't think there's any cons to this. So yeah. Fifth, courses. By going for courses, you can actually save on taxes. As usual, there are terms and conditions. First, you can claim up to $5,500 tax relief from courses. Second, only courses, seminar or conference that's related to your current job qualifies. So that means those Wealth Guru courses by Imran or Dominic doesn't qualify, yeah. Besides, why pay thousands of dollars to attend financial course when you could just watch some random YouTubers teaching the same thing for free? 6. If you have a kid, you can also save on taxes. Legends once say that you only need a very small space to do it. There's a whole bunch of tax savings if you have kids. You have the qualifying child relief worth 4K, parenthood tax rebate, 5K for first child, 10K for second child, 20K for third child and subsequent child. That's not all. If you are a mom, you can save 15% off your taxes for first child, 20% for second child, 25% for third child, and so on. Oh, if you got a helper, parents or grandparents helping you take care of your kid, you can also claim tax deductions. So yeah, seems like the government wants to encourage us to have kids. If you haven't claimed before, you will need to log into IRAS to do it. IRAS has a step-by-step guide on how to do it. Besides kid, there's also parent relief. Yep, the government also wants you to be filial to your parents and grandparents. If your parents stay with you, then you can claim 9K tax savings per parent, meaning it's 18K for 2 persons. If your parents doesn't stay with you, then you can claim 5.5K per parent. But you have to show that you spend at least 2K to support them, yeah? If your parents are handicapped, the amount that you can claim are higher. Again, IRAS has a step-by-step guide on how to claim this. So go do it if you qualify because the savings are huge. So those were the 7 ways you can save on taxes. Lots of tax savings. But take note that there's an 80K tax deduction limit, yeah? We will still need to contribute to nation building, obviously. And that's all for today. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.